Okay, here we are. After a year long of chasing a strategy and trying to learn a strategy, I could not just find it. Um, Trading fair value gaps, trading other different strategies, just not for me. So it took me a very long time into actually learning because I'm the type of person that want to know the why behind everything. After searching and searching and searching, there's literally no simple video that I was able to find on the internet to describe what I am going to do my best to try and describe in this video. Um, there are not a lot of indicators that I've used. Now I've back tested this strategy way back for like 2 years, and I've been forward testing this strategy, and it works. And I really encourage you to back test this and forward test this. And when it clicks, it's just going to click and it's going to make a whole lot of sense. Now, if you don't understand fair value, you'll chase breakouts. If you don't understand rejection, you'll fade strong trends. And if you don't understand volume, you'll think price is lying when it's actually telling you the truth. And so, what I've learned is that the market really moves behind the auction market theory, and you add volume to it as well. Okay. And if you do that, if you learn the auction market theory and you add volume to it, you will stop getting in trades early and you will stop cutting winning trades early. Now, this video is not about an entry strategy. It is not about a signal system. It's just a foundation. In this video, I just want to lay the foundation so that you can understand how the market works. And I want to save you a bunch of time, like, so you not have to waste a lot of time. Now, understanding this, you definitely will have to put your time in because I've put in countless amount of hours. Now, I'm going to try and make this very, very, very simple. So, a lot of times you would get people that teaches this is how the market goes up and down, taking out highs, taking out lows. That is what they teach you. But in this simple video, I want to teach you how the market moves. Okay. So you will have a market where, let's say, you have that there, and you have this here. So the market always moves from a balanced market where price is staying in between here. A lot of people like to call them chop boxes or whatnot. This is what you call a balanced market. So anytime price comes out of this balanced market, it's imbalanced now. And what it's going to do is search for another balanced market. Okay. It's going to search for another one. Say here. And when it finds it, this price may start here and it's going to come back up to this balanced market. And let's say, okay, if it comes out of this balanced market, it's going to find another balanced market. And it could be the balanced market that it left. And so pricing will come back down here. It would shoot through it, maybe come here and bounce back up, come here, there, then come down there. So, and then go out of balance again. So the system, the way it is, the way it's rigged, you have balanced markets that's in between a price, and then you have unbalance. Okay, and so let's just find a couple of examples here, and I'll show you how to put it together. What I've learned. So what I've learned is to start on a higher time frame. But let's just go. Let me just show you right here. Right here. Let's use this right here. So let's say right here we have a balanced market, right? We would call this a balanced market. Now, if we was to zoom in on a lower time frame, we would see how price was moving inside of this balanced market. Okay, so right here, I could just use this here. So right here, we have a balanced market. Right here, you have a balanced market. Okay, then it came out of balance right there. See right here, you have a balanced market right here, and then it came out of balance. Then it went back. It retested a balance, but it came back to another balanced market. It's all over. So if you look right here, another balanced market here, and then it came out of balance. Then it came through the balance. It did a little trading inside of here, then it came out of balance. If you look right here, and this is called the auction market theory. You have a balanced market here, and then it's unbalanced. You have a small balance here, right in there. Then it went unbalanced. Another small one here. And when you're on the bigger time frames, you only need 2 to 3 candles for a market to be balanced. And so let's just say I'm gonna have to come up here because you can't go back too far. So let's just use this area right here. This area right here is what you would call a balanced market. I would start from here. This is a balanced market. Now you start off on a daily, and the daily, and let's say um, we go down to the 4 hour, and you see in the 4 hour how it's balanced right here. This is a balance, okay? And if you go down to the 1 hour, you're still in balance. And let's say you're looking for a trade, like I like to use the 30-minute time frame. So we already know we're within a balance right here. And so what you would do, you would find another balanced area within the range. So on my 30-minute time frame, that's where I find them. So if you look right here, you have, I would say from about here to here, you have a balanced market. Okay. If you look at this 30-minute here, this is another balanced market right here. Went from balance to imbalance. You have to start training your eyes to see this. Once you train your eyes to spot them, you will always be able to mark them out. This right here was a balance before it took off. So if you look here, it's another balance here. Why is it describing? Here, and this is a 30-minute time frame. You see how it's balanced, and then when it went imbalance to find another balance. So this balance here, price came up and found this balanced market right here. Okay, so if you look right here, price was balanced all right here. And when price came out of balance, if we go to the left right here, we're going to find another balanced market. So if we come over to the left here, and you see right here how price found this balanced market. We do it one more time, just one more example. The reason why I'm showing you so many times is so you can get it, so you can understand it, so you can spot it, and where you know to draw your zones. Let's just say this one right here. Let's say this right here was a balanced market. Now, now what I want to do, I want to extend this. Go to settings, and I want to extend this to the right. Now, this is how you set up your high probability trades. So if you right here, this balanced market, you can wait until price come down here. Or you have another one right here, but we are zone. Let's just say we're patient. We're going to wait, and we will find price come down here. And look, price came back down in here, and this will be your high probability trade. So since we're right here, let me just show you the meat and the butter to finding high probability trades. You're going to go from balance to imbalance, balance to imbalance. That's all the market does. So now, if I was to add a fixed range volume profile to this and watch and see what the levels you get. And so if I draw from here to here and I just wait until price come to these areas to accept it or reject it. And when price, you have to remember, mm, yeah, let's see here. Let me turn this off. Turn this VWAP off. Let me let me go here. Go, let me go there so you can see it really well. Let me turn this down. Okay, so when price is in between here, this is your value area low. This is your point of control. This is your value area high. So when price is in between here, price will make full rotations. It would go from your value area low to the POC. It can reject off the POC, come back down to the value area low, come back up to the POC, and it could trade right through the POC to the value area high. It made a full rotation, then it could come back down. So right in between here, this is when a market is in balance. So because the market is in balance right here, so we can wait. So if we go out of balance, and let's say all this is unmitigated here, where price have not revisited. So if price goes up here, we then wait for the high probability trade. You wait until price come back down and retest the value area high. So you want to be on alert. Just because price come to the value area high do not automatically means jump in a trade. If you do that, you will lose. You have to watch what price is doing. You also need to understand reversal patterns. You also need to understand acceptance and rejection. Okay, so if price come down here, let's say if it started accepting a lower price, because potentially when you are trading the value area high and the value area low, you want to look for a failure of buyers going higher. And when you're at the value area low, you always potentially want to look for sellers to fail. So a lot of times buyers would absorb the price here and then you would get a rejection. And how you know you would get a rejection from both of these, you will have to watch the candlesticks and you will have to watch the wicks. Okay. But typically, how you trade from the value area low, you will always want to go back to the point of control where fair pricing is. So we already know if you want to trade, if you potentially seen a price came down below the value area high, you typically want to go for the POC, okay? Because that's always going to be a magnet. But in this case, it really wouldn't make sense because the POC is so close. It's only 24 points. But if you want to take it to full range, that was what 130 odd some points, 127 points. You could take it, but your candlesticks have to be right. You have to know how to read the candlesticks. You have to read the wick rejections. You have to know what certain candles do. It's not you're not reading the candles because I don't want you to make a mistake when you're just reading candles because you would get stuck in that loophole. And when it's not about that, it's all about the auction market. If price or not is not accepting lower prices, the wicks would tell you that. They would tell you. So, for instance, so if let's say if you are a disciplined trader and you are a patient trader, you're going to wait till price. And if you decide to wait the price come down to this area, you want to go ahead on a market. And I have these colors. Um, it can be any color that you want. Um, so I have the green, my POC is yellow, and my value area low. So if you wanted to just wait till price came down to these levels, you can do that if you have the patience. So let's say we're just waiting on price to come down to this level. Let me turn the candlesticks back on. So this is December the 18th of 2025, and price did not come back down to this area into January the 2nd. Okay, so you could have set alarms. You just click on the line, you right click, and you can just add an alarm. And what I like about setting these different alarms, this is not this type of video, you have to do the research. Let's say if you know this is where your alarm wanted to go off on, you can set it where this alarm will go off 10 or 20 points before it hit this actual line. So let's say for instance, if we were trading on this day, if we were trading on this day, waiting on a high probability trade, we already see from December with the 19th all the way to the second. This was a high probability trade that we were waiting on. So if you had these already locked and you already had an alarm, so when price came to this area, you would have known, okay, I need to look for. You would know what to look for. So since we're using this example, let's say if price came down here to this area right here, you would drop down to the 5 minute or the 1 minute for your entry. Okay, so we're waiting. So we're going to the second. I guess I could have went to the date. So let's say for instance, your alarm goes off and now you're here and now you're watching. You see how price came down here. It went through the value area high. It came straight to the POC. And what it did, it created another range right in here. It created a small range right here. So if you was to draw another fix, So price came to the POC, which is the point of control. That's where the buyers and sellers felt like that's where fair pricing was. So price is always, sometimes always going to go in a range when it comes to the POC. So if you see right here, we had a small range, and let's say price came down here and you're just waiting, and you could grab your fixed volume profile, and on a smaller time frame, you want one, two, three, at least four candles, and it would create a range. And so if you look at this very small profile right here, pay attention to this. This is what's going to help you a lot. Again, this is not an entry video. This is just showing you the dynamics with auction market theory and adding volume to it as well. As you see, price came down to the value area low. This is the POC, and it came up. It did a full rotation. It came down. It did another full rotation. It went above this original, and then you see how it went above how price, how buyers was absorbing this here. So you can extend this fixed volume profile out. If you extend it out, you would see how price start coming down. It came, it's to the POC again, and now price is rejecting it. And so you still want to sit on your hands, and this will tell you right here that stay out of this zone for right now. When you are in the middle, you want to stay out of that zone. You do not want to trade the middle. When you trade the middle, that's when you get chopped up. As you see how this was very, very choppy in the middle. And so you're just waiting and waiting. You can do one or two things. You can wait until the chop is done, or you can wait until price come back up to the value area high and take a short. Because remember, I told you potentially when price is at a value area high, you want to take shorts. When price is at a value area low, you potentially want to take buys. So you can be waiting, sitting patiently, and just waiting until price come to like maybe the value area low or the value area high. Now, here's something else that I want to um, introduce you to help you with not help you with your entries, because again, like I said, this is not an entry video. So what I like to do, I like to draw boxes around my zones. In the next video, I'll share how big these boxes should be, because it would only make sense because these boxes are really good maps. So as you see from the what from 1219, price made a full rotation from the value area high, came down to the value area low. So again, we'll say this right here will be your balanced market right in here. Uh, right here. Start from here and stop it right here. I don't know. Let me understand this. So from here to here, let's say about here, you have a balanced market. But in this big balanced market, you have these little smaller ones as well. This is how I find my entries. So right here, you see how here again it made a full rotation in this small piece here, coming all the way down here. So if I was to draw a fixed volume profile from here to here, because it came down here, you would see how price from here made a full rotation. From this, if you can see it, hope you can see it. from this value area high here to this value area low. Price accepted it. But the overall value area high is here. Overall value area low is here. This is where you want to pay attention to what price is doing. And so you could have taken a buy from this area down in here. Could have taken your buy from here, and your target would be your next balanced market, which would be here. So if I was to, let's say, go to settings and let's extend this now to the right. So this is what, like, balanced here. Now if we go over to the right, it's coming back in balance right in here. You see? And your target could have been the beginning, this middle, or the end. Okay? So again, price is always going to go from balance to imbalance. And how you find your entries, you add volume profile to it as well. And you just wait. So like here, we have a balanced market here. It's a balanced market here. And now if I was to extend these lines here, right? This would be the POC. This is my value area high. And so for a high probability trade for me, I'm just waiting. So this right here happened on the 14th of January. And as you see, 4 days later on the 18th, we we had this opening gap and it came down in here. So you could have been watching for this here. As you see that price did not accept higher prices. Price began to accept lower prices. So, but if you look right in here, you have somewhat of a balanced market. So I'm going to draw my fixed range. Okay. Again, this is the overall range right here. So I'm drawing a smaller one to look for an entry. So let's say I wanted to find an entry. Price is always going to come to the POC. And so as you see here, this is how I was able to find a short for today and a long for today. I have my fixed range profile here and here. And last night I seen that price was rejecting the value area low from 4 days ago, which is right here. And so this is what made me go into a short last night and ride it all the way out to, you see how price came down here. So if I draw a rectangle here, and let me extend this one to the left. And this area right in here was my target because of this right here. Because look again, you have somewhat of a balanced market. I believe I took this here. So if I draw my fixed range from here to there, and if I extend my lines, remember price is always going to go to the POC. Always going to go to the POC. And before I forget, this is not a financial advice video. I am not giving financial advice. So we color these so we can know exactly where we're going. So let's go back over here. This is the overall I was going off of because this is the high probability trade for me because all this is unmitigated because price has not visited it. But we had the opening gap here. And so like I said, if you look right here, once I seen that price was not accepting higher prices, I notated that and I seen that. And so once I began to see price has number one rejected the value area high here, so went right through the point of control and it came back up to retest the point of control to make sure this was a good resistance. And so this what made me get into the trade for a short and hold it to the POC here. So price was rejecting here. I seen that it was rejected this value area high here, right? So price broke through it. It made a rotation. I said, if it comes back up for a retest, that's where I'm going to get in for the retest. So I got in for the retest, and my stop loss was here. I, I try and make my stop losses no more than 30 points. If it's anything more than 30 points, I leave it alone. But again, this is not an entry video, and so this was a 1 and 3.6 right here. As you see, price it came up to retest it, and let's say at about 8:15, from 8:15 to 2:40 in the morning, that was a winner. So this is NQ. So if you had just two contracts going, this may be MNQ. This maybe which one is it? I don't know. Anywho, so if you had 10 contracts going, why is this not changing? You could have made $2,000. And so if you got in here at 8:15, price hit at 2:40 a.m. 77 bars. So at about 6 hours and 25 minutes, you would have made $2,140. But again, this is not financial advice. Your risk was only $595, or you can do something that I started doing, which I got from another trader. Um, Smash shout outs to him. I learned from him from afar. His name is Thomas. But what I really like what Thomas does, you see how um, the stop loss is 29 points. Your TP1 should be 29 points. And once your TP1 get hit here, okay, your TP1 here, you have your TP1 there. You can take off half. So you could have taken off, 5. So if price would have hit your stop loss while you're asleep, you wouldn't have lost any money. It would have been a break-even trade. Or if you was up, once price hit TP1, wherever you decide where TP2 is, you can either take your TP2 or you can just let it ride. But your full TP is here. You could have just brought it to break even. So let's say, for instance, I will show you one more example. Let's just show you one more example. Let's say it's now, let's say, for instance, if we were looking for a trade to get in for the day. All right. So let's say this right here. Let me just remove these drawings. Just say here again, this right here in this area was a balanced market. Okay. Let's say right here, you woke up with 7, 8 o'clock in the morning. You will want to find balanced markets. Okay. So you have a little balanced market here. You have a little bitty balanced market there. A very small one right there, right? So let's say, okay, if you want to try and find a trade, you have your balanced market here. You have your box drawn, and you would take the fixed range profile, and you will want to read and see what it has done already. As you see, price accepted higher prices, but then rejected it. But if you look right here in this area, you look here, here, and here. You can draw quick profiles. So price was rejected there. I will draw one here to see what the auction is doing here. I say, okay, here, okay, that makes sense. So price just want to go lower. So that would make sense why price just came here and dropped down. So if I wanted to extend this all the way across to here, call this whole entire range right here, balance, this would make sense why price rejected at this value area low. So that let me know, okay, so let's say 8 o'clock right here. I have another one. And so, okay, price came up to this value area high here. Price did not accept higher prices. And so now it's 9 o'clock. And this is how I found the short for today. And so, although this is on the 5 minute, I dropped down to the 1 minute and I took it to I actually took it to the value area low. So I got in this trade. Once I seen it rejected here from the POC, um, I think I think this is a very tight stop on this one, and I took it to the POC here, right there. It wasn't many points, but again, price is going to go from imbalance to balance. This was like my balance range, and so after I exited for 43 points here, once I exited for 43 points here, then I began to look what price is doing again. So price went right through this value area low, and I seen how, and again, so this goes back to understand your candlesticks. I seen that this was a doji here, and I seen that this candle took out the liquidity. Now this is extra right here, what I'm giving you. Okay, I seen that price took out this liquidity. I said, okay, price has taken out this liquidity, so price is reversing. This is a reversing, and also has made a quick V. And I said, okay, well, I have a fair value gap here, the fair value gap here. And for what I've learned through back testing, price don't always come all the way back down here to close a gap. It would a lot of times close this first one. And so what I did, I said, okay, let me look at this. I looked at price and I said, we got a look like we got a nice little range here. And so what I did, I went from here to there and I seen my profile and I was liking how it was looking. How price did come below here. It went through the POC, right? Because this is the main ground right here. And I say, okay, this is where you would need to learn how to be patient as a trader. So I said, okay, if I was to get into a buy, I will wait until it retest the POC. And so I waited till a retest came. So price came back down and it retested the POC. Again, my stop, I believe this time I put my stop like halfway. Uh, 30 is like my max is what I'll go. So it came back down, and my target was this value area high right there on the small one. I could have went to this one or this one. I believe I went to this one right here to that one. And so that's where I got out of the trade at. So again, I would have did risking 660 bucks, another $2,100 right there. So I hope you learned something and I hope I didn't bore you guys. I will be doing another video on making really good entries in the size of your stop loss. Thanks for listening. Thank you for your time.